Ever wondered how chart patterns could be your secret weapon in the stock market? Well, chart patterns are like the footprints of market psychology. They're the visual representation of the collective actions of all market participants, and they can provide us with a wealth of information. When you're able to recognize these patterns, you're essentially learning to understand the language of the market. You see, every pattern tells a story of supply, demand, and investor sentiment. And when these stories repeat, they form patterns that can help us predict future price movements. Chart patterns can be as simple as a line or as complex as a head and shoulders, but they all share one thing in common. They provide trading signals. These signals can guide us when to buy, when to sell, and even when to sit on the sidelines. Now let's delve into a few popular chart patterns that every investor should know. First up, we have the head and shoulders pattern, a classic in technical analysis. Imagine a human figure in your mind. Now imagine that figure in a stock chart. Yes, you heard it right. The head and shoulders pattern is named so because it resembles a human figure with a head and two shoulders. This pattern is a common sight on stock charts, and it's a significant predictor of a potential market reversal. Let's break down the anatomy of this pattern. On the far left, we begin with the left shoulder. This is formed when the price of a stock rises to a peak and then declines. Following this decline, the price rises again, forming the head. The head is higher than the left shoulder, indicating a new peak, but hold on, this joyride is short-lived. The price falls again, often to around the same level as after the formation of the left shoulder. Now we come to the final part of our human figure, the right shoulder. The price rises again, but this time it fails to reach the height of the head, forming the right shoulder. The price then declines one last time, but here's the catch. It generally stops at the same level as the previous declines. This level is known as the neckline. So what does this pattern tell us about the stock market? Well, the head and shoulders pattern is a bearish signal. It indicates that the stock's price, which was previously in an uptrend, is likely to reverse and enter a downtrend. This pattern unfolds over time, and the more well-defined it is, the more reliable it tends to be as a predictor of market direction. But remember, no pattern is foolproof. While the head and shoulders pattern is a powerful tool, it's important to use it in conjunction with other technical analysis tools and indicators for the best results. So, the head and shoulders pattern could be your early warning sign of a potential bear market. Remember, investing is not about predicting the future, but about making informed decisions based on the information at hand. And patterns like these can provide valuable insight into potential market movement. Next, we have the double top and double bottom patterns, two sides of the same coin. These patterns are quite the telltales of the market, hinting at potential trend reversals. So, let's dive into understanding these intriguing patterns. The double top pattern is a bearish reversal pattern that appears at the end of an uptrend. Picture this: the price rises to a certain level, then falls back, and then rises to the same level again before declining once more. The result is a pattern that looks like an M. The two tops represent strong resistance points. When the price falls below the neckline, the lowest point between the two tops, it signals a trend reversal from upward to downward. The double top pattern is a warning to investors that the bulls are losing steam and the bears are ready to take the reins. On the flip side, we have the double bottom pattern, a bullish reversal pattern that appears at the end of a downtrend. This pattern is the mirror image of the double top. The price falls to a certain level, rises back, falls to the same level again before finally rising. This creates a W pattern. The two bottoms are strong support points. When the price rises above the neckline, the highest point between the two bottoms, it signals a trend reversal from downward to upward. The double bottom pattern is like a light at the end of the tunnel for investors, indicating that the bears are running out of steam and the bulls are ready to charge. These patterns might sound simple, but spotting them in real-time market charts can be a bit of a challenge. It's like finding shapes in the clouds. Sometimes they're clear as day. Other times, they're a bit more elusive. But with practice and patience, you'll get the hang of it. These patterns are a reminder that what goes up must come down, and vice versa. So keep an eye out for these double top and double bottom patterns, as they could be key to predicting the next market trend reversal. Moving on, let's explore the cup and handle pattern, a favorite among bullish investors. Picture this, a teacup with a handle on the right. That's essentially what the cup and handle pattern looks like on a stock chart. The cup is a curved U shape, representing a period of consolidation after a significant price rise. The handle is a slight downward drift, a small pullback before the stock resumes its upward climb. Now, let's break down the components of this pattern. The cup forms when the price drops from a peak and then rises back to that same level. This is a period of consolidation where the market is taking a breather, testing support levels, and preparing for the next move. The depth of the cup is usually between 1/3 and 2/3 of the previous uptrend. The wider and deeper the cup, the stronger the signal. The handle forms to the right of the cup. It's a smaller, downward-sloping trend line that resembles a flag or pennant. This represents a final sell-off or profit-taking before the next breakout. The handle should not drop into the lower half of the cup and should be relatively short-lived, usually lasting a week to a few months. Once the price breaks above the handle's resistance level, we have a confirmed cup and handle pattern. This breakout is the signal for investors that the stock is likely to continue its upward trend. As with any chart pattern, the key is to wait for confirmation. In this case, the breakout before acting. Let's illustrate this with a hypothetical example. Imagine a stock that climbed from $20 to $60, then consolidated and formed a cup from $50 to $60 over 6 months. The handle formed over the next month with a slight pullback to $55. Once the stock broke above $60 again, that was the signal of a continuation of the uptrend. Remember, the cup and handle could be your ticket to ride a bullish wave, but as always, use it in conjunction with other indicators and analysis tools for the best results. It's not a guaranteed win, but it's a powerful tool in the hands of a savvy investor. Lastly, we have the triangle pattern, a versatile tool in your trading arsenal. Triangles are chart patterns that can help you gauge market sentiment and potentially predict future price movements. There are 3 main types of triangle patterns: ascending, descending, and symmetrical. Let's dive into each one to understand what they signal. First, the ascending triangle pattern. This forms when a stock's price has a flat top, but the lows are steadily increasing. Essentially, this means that the stock is experiencing higher lows, but it's struggling to break past a certain high point. It's often seen as a bullish pattern, signaling that buyers are more aggressive than sellers, and a breakout upwards might be imminent. Next, the descending triangle. This is the mirror image of the ascending triangle. Here, the price has a flat bottom while the highs are decreasing. This can be interpreted as sellers gaining strength, pushing the price down, but meeting resistance at a certain low point. It's often viewed as a bearish pattern, hinting at a potential downward breakout. Finally, the symmetrical triangle. This pattern is formed when the price is making lower highs and higher lows, causing the 2 trend lines to converge towards each other. This indicates a period of indecision in the market with neither buyers nor sellers gaining the upper hand. Once the price breaks out of this triangle, it can move in the direction of the breakout, providing a potential trading opportunity. Remember, these patterns are not guaranteed predictors of future price movements. They're tools to help you understand market sentiment and make informed trading decisions. Use them in conjunction with other technical analysis tools for the best results. So, whether it's a showdown between bulls and bears or a period of indecision, the triangle pattern can give you valuable insights. To recap, chart patterns are a powerful tool for predicting market trends and making trading decisions. We've journeyed through some significant ones today. The head and shoulders pattern, a reliable indicator of a market's reversal from a bullish to a bearish trend. The double top and double bottom patterns, both excellent markers for potential price reversals. The cup and handle pattern, a bullish continuation pattern that marks a period of consolidation before a breakout. And finally, the triangle patterns, which include the ascending, descending, and symmetrical triangles, each serving as a key signal for either continuation or reversal trends. These patterns are not just designs on a chart. They encapsulate the psychology of the market, reflecting the push and pull between buyers and sellers. With a keen eye and a bit of practice, you can learn to spot these patterns and use them to your advantage. Now that you're familiar with these chart patterns, you're one step closer to becoming a savvy investor. Keep practicing and happy trading.